negate resolve, the United States federal government should prioritize reducing the federal debt over promoting economic growth. Our sole contention is productive growth. The U.S. economy has been booming in recent years. Amadeo of the Balance reports in 2019 that U.S. economic growth is expected to remain between 2 and 3%. Unfortunately, even though the economy is currently at full employment, Stiglitz of Columbia University explains that millions of Americans remain in part-time or underskilled positions with minimal wages. This is exactly the case today, as while the federal unemployment rate is 4%, the U6 unemployment rate, which tracks individuals in part-time or underskilled jobs, is 8%. This is because Irwins of New York Times explains in 2018 that productivity growth has largely been in the weakest decades because the roots of the economy still have not repaired themselves after the damage caused by the 2008 recession. To ensure our growth is sustainable and avoids recession, the government needs to prioritize productive economic growth. Negating does this in two ways. First is research and development. Campbell of Atlantic Council explains in 2013 that U.S. is the global leader in R&D spending. Government supports flatline when adjusted for inflation and is expected to decline if sequestration budgets are fully implemented to reduce the debt. This halts the programs in energy, agriculture, IT, and defense. This is terrible. As Tassi of the National Institute of Standards and Technology explains in 2017, the only path to long-term growth is to steadily increase productivity growth, and technology is a long-term driver of that productivity growth. In fact, the critical point for economic growth policy in the United States has always been technological growth. The Trump administration has further contributed to the growth of Silicon Valley. Baram of FCI finds in 2016 that tech companies have received billions of dollars in tax cuts and tax breaks. On top of this, Colgren of Politico finds in 2017 that hundreds of millions of dollars in grants have been given to women and minorities for tech education and startups. This investment directly stimulates economic activity. Castelli of the Institute for Labor Statistics quantifies in 2016 a 10% increase in R&D capital stock increases productivity by 2.55%. In addition to helping the United States, technology helps the entire world. Evans of Huffington Post explains in 2012, technological exports to developing countries provide a viable path to end global extreme poverty since they provide new economic and educational opportunities for the population. This is why Jamont of IMF quantifies the relationship in 2013, finding that rapid technological progress in developing countries has helped raise incomes and reduce the number of people living in absolute poverty by 18%. This is crucial, as UNICEF in 2014 reports that 1 billion children in the developing world live in poverty and 22,000 of them die every day as a result. Second is domestic infrastructure. According to Editor's Medium magazine in 2015, 65% of America's major roads are in terrible condition and a quarter of bridges are in need rehabilitation, disproportionately in low-income areas. This is why they find that 55% of Americans lack access to public transit. Fortunately, McNicol of CBPP finds in 2018 that Congress plans to invest $1 trillion in infrastructure to boost economic growth. However, infrastructure and debt prioritization are mutually exclusive. As Boa and Reason magazine explains in 2018, the infrastructure plan is being financed primarily by foreign and domestic borrowing, adding to our deficit. If you want infrastructure, you negate here. Investing in public infrastructure not only grows the productive capacity of the economy, but creates avenues for employment and poverty reduction. Bivens of the Economic Policy Institute furthers in 2014, $18 billion in annual investment leads to a $29 billion increase in GDP productivity and boosts overall employment by 3 million new net jobs. This adds to the productive capacity of the economy as a result. The overall impact of productivity is improved standards of living. Productivity electrifies every aspect of the economy and benefits every household. Hornbeck of the National Bureau of Economic Research in 2018 concludes a 20-year meta-analysis of United States productivity that a 1% increase in total productivity increases long-run earnings by 1.5% and employment by 4%. Even better, he finds that workers in the bottom income percentiles see substantially greater earnings since they are the ones who benefit from receiving new jobs and a living wage. Because of this, we negate.
Can I see your like the first card you read under research and development?
Sure. Yeah.
For Tassie.
Can't be. I don't know how you pronounce it. Here you go. This is the one on the left, and the first. The specific part is at the bottom, but there's more context at the top that we highlighted.
Oh, where's the part about the debt? Like the debt taking away from this?
Oh.
From research and development?
Then like the when it's done by borrowing? That's about infrastructure.
Oh, okay.
Oh, you mean the sequestration part? The sequestration part and budget cuts are right there.
Oh, okay, cool. Thank you. Okay. Okay, cool. Thank you. Okay, I got like 12 seconds.
also just for the judges, I have a little bit of a cough, so if I like cough in my speech, like I'm sorry.
You're gonna alright.
Just want to like let you know before. Okay. Is everyone ready? Cool. If everyone's ready, I'll start the time now. Francesca and I affirm our sole contention is the doomed debt disaster. The United States federal debt has soared to unsustainable levels. Trading Economics 17 reports that the debt stands at $21 trillion, totaling 105% of US GDP, a historical high. The debt will only grow. Post and 16 of Brookings finds that Trump's recently passed tax cuts will plunge America $10 trillion deeper into debt. The United States is running out of places to borrow. Davy 17 reports that because of the unprecedented increase in the debt since 2000, foreign debt investors have lended 17% less annually, and domestic investors have lended 2% less annually, concluding the government must soon entirely turn to the Fed, who pays the debt by printing money, drastically increasing inflation. Amadeo furthers 2 days ago that inflation generated from high debt will collapse the value of the US dollar, creating global economic turmoil as investors flee to other currencies like the yuan, leading to hyperinflation, high interest rates, and market volatility, inevitably sending the United States into a depression. More specifically, letting the debt surge will result in 2 devastating impacts. Subpoint A, the fiscal stimulus. The federal government releases a fiscal stimulus or an increase in government spending during a recession to prevent further damage and to kickstart economic growth. Unfortunately, Haw 16 warns that a high debt load constrains the government's ability to release a fiscal stimulus without triggering a debt crisis. For example, Collins 18 notes that due to low debt levels in 2008, the government responded to the recession with a large stimulus, paving the way for economic recovery. However, he finds that the current mounting debt eliminates the government's ability to respond to future downturns, making the recession deeper, longer, and more painful. Blinder of Princeton University 10 explains that without the 2008 stimulus, GDP would be 11.5% lower, 8.5 million more jobs would be lost, leading Danziger 12 to conclude that the stimulus package reduced the number of people living in poverty by 2 million. Even if the government can pass a fiscal stimulus, Romer 17 from UC Berkeley explains that high debt empirically causes policymakers to delay intervening in the beginning of a downturn, resulting in a 6.7% larger drop in GDP. Subpoint B is interest. Boskin 18 explains that the United States debt rises, debt holders demand higher interest rates to compensate for the increased risk in government defaults or delays repayment. For this reason, Moore 10 finds that a 10% increase in the debt causes a 2-point climb in U.S. interest rates. The first impact is cutting welfare programs. Tully 18 finds that 1/5 of the government spending will quickly go to servicing the interest on the federal debt. Because the debt and interest payments cyclically compound, the CRFB 18 explains that waiting 10 years to reduce the debt increases the size of needed cuts by half, concluding a debt reduction package now would boost the average income by $5,000. Collins 18 furthers that a large interest payments take away from limited government funds and make it impossible to prop up financially strapped welfare programs, concluding Medicare will run out of money by 2029 and Social Security will be insolvent by 2034 unless steps are taken. Ravaging the welfare would be disastrous. Campbell 18 of Vox finds that these welfare programs directly kept 45 million people out of poverty in 2017 alone. The second impact is electrifying emerging markets. The BBC 18 explains that the higher U.S. interest rates disincentivize investors from investing in developing economies because they gain higher returns from buying U.S. Treasury bonds. In fear of losing capital, central banks in these countries hike their own interest rates in response, making it harder for the poor to access credit. They continue that rising U.S. interest rates already are fueling currency crises across the globe in Argentina, Turkey, and Brazil. The more interest rates rise, the worse it gets. Navarro 18 of the Journal of Monetary and Finance empirically verifies that every 1% increase in U.S. interest rates reduces developing nations' GDP by 0.8%. Historically, a 2015 Jubilee Debt Campaign report finds that rising U.S. interest rates in the 80s and 90s single-handedly erased 2 decades of economic development in emerging markets and relegated an additional 125 million people into poverty. Affirm.
Awesome. Is everyone good? Okay. So at the top of your case, you say that debt to GDP ratio is at 105%,
Yeah.
and that means it's unsustainable.
Yeah, you say
Why
it's
is it-
historically high.
Why is it unsustainable?
I mean, for like all of the reasons we give in our case, right? Because of
Okay.
the mounting debt, like we're unable to.
So
process-
after World War II, we had a debt to GDP ratio of 125%. Japan has a debt to GDP ratio of 255%. What makes it uniquely 105 that's unsustainable?
Yeah, well, uniquely right now in the United States, things like our investors like currently leaving because of the high like interest rates, and then the interest rates like hurting things like welfare and like emerging markets. It's things like that uniquely in the
So
United
it's about
States.
investors leaving then.
Yeah, that's like part of
Okay,
it.
so where are they going?
China.
China.
Yeah.
So
But
like
can
you're
I have a
saying that,
question?
this is just one quick follow-up,
Sure.
right? So you're saying they're buying Chinese bonds.
Yeah, they're like moving into the China because like it's
Okay,
much
wait.
more stable.
You can't buy Chinese bonds, they're closed currency.
No, they're like investing in like the Chinese currency over the United
Well,
States
you
right
can't,
now.
you literally
Can I
can't
ask-
buy Chinese treasury bonds, they don't exist.
Okay, well they're investing. Like you can call for cards. Like they're
Okay.
investing in China.
Okay.
Okay. Can I have a question? So on this idea of like R&D, right? Like what's the probability of like the United States like government like investing in R&D?
Pretty high, they're doing it right now, that's where our evidence is.
Okay, like what types of jobs are like these R&D jobs?
High school jobs,
High skill jobs, right? Like
Yeah.
how many people are like unemployed right now that need high skill jobs?
a lot of them. That's why we reach you the U6 unemployment rate. A lot of people are high skilled but stuck in part-time or under-skilled jobs, which is why when you create more job opportunities for high skilled jobs, you increase productivity and you increase GDP growth. Can I ask you a question?
Sure.
Okay, let's talk about your subpoint B about interest rates going up,
Yeah.
right? Your second impact is about emerging markets.
Yeah.
So are you just talking about like FDI into emerging markets?
Kind of, yeah, but not really, right? So like what it is that
Like-
right now because of the rising interest rates, investors would rather invest in U.S. Treasury bonds
Right.
because that's where they get the most money,
So
right?
like the treasury bond looks more attractive than an emerging market, right? So it's about FDI in emerging markets.
Yeah, which then
Okay.
causes like interest rates to rise. In,
So
like, emerging
one quick
markets.
follow-up.
For sure.
Why do people invest in U.S. treasury bonds?
Because of the rising interest rates,
No, like, but generally, like, why do people invest in treasury bonds?
because they want to make money.
Right, but like comparatively to other investments, what gives treasury bonds a unique advantage?
I mean, I would say they make more money on them.
No. Treasury bonds are very long-term, very safe, and no-risk affiliated investments.
Yeah, but like people
Right.
are turning to them even more
So-
now because of the
So
rising
let's
interest
so
rates.
let's do the comparison, right? Compared to a developing country, why would somebody invest in a developing country?
What, to make money? Like that's why everyone.
Right.
Yeah.
So
but
it
right
has,
now.
it has a higher rate
yeah.
of return at a greater risk because it's a
Yeah.
developing
Okay,
market.
but I would say.
In comparison, a treasury bond's demand is completely different because it's a very safe investment that
Yeah.
happens regardless
No, I know.
of whether or not
For
developing
sure,
markets exist.
but right now investors are turning towards
Sure.
those treasury
So,
bonds
okay.
uniquely because of the high
So
like,
here's
interest
the
on
important
debt.
follow-up, right? So how much is the turnover to the developing market? How
How-
much? Because I'm saying the demand's probably very different. You're saying it's pretty close. So tell me how many investors are changing?
I'm not exactly sure how many.
Okay.
We're gonna take some break. Starting.
There's 3 minutes. There's 3 minutes.
Yeah.
That's pretty cool. Well, I care.
I think you came in later.
Yeah, I did do that.
Okay. So it's gonna be starting out with some wing on the top, and then
On top of their case or your case?
on top of their case.
Okay.
Yeah. Does everyone get- Okay. They're already behind this debate because our case fundamentally outweighs theirs on 2 levels. First, because of our subpoint A on technology. Research and development stimulates productivity growth that is empirically solved back for high levels of debt in the future. Look at the 1990s. When Clinton was in power, he was the only one who has ever balanced the budget and make sure that we had stable levels of debt. And he did that using the 1990s internet boom in order to do that in the first place. So our subpoint A is solving back for their entire case. But secondly, infrastructure fundamentally outweighs their case as well, because according to the University of California, Berkeley in 2011, if we don't invest into deteriorating infrastructure right now, it becomes so much more expensive in the future. He quantifies that this could add $3.1 trillion loss in GDP, which would fundamentally add to the debt in the future. That's a really bad thing. If you buy anything that they're saying in their case that debt is bad, you have to vote for us first. With that said, let's get into the nitty-gritty. They start out their case by saying that the Fed is going to print more money causing inflation and that less foreigners are investing in the United States. This directly contradicts what they're saying at the bottom of their second subpoint about emerging markets, about more investors wanting to invest in the United States away from emerging markets in the first place. So make them choose which one they're going to be going for right here. But on top of that, we would say, according to the Harvard International Review in 2013, that the United States is the global reserve currency, meaning that there's always going to be a high demand for dollars because every single financial transaction is done because the dollar is the safest currency. They say investors are shifting to the yuan, but that doesn't make any sense because China is a closed economy. They are a communist regime. There are no property rights whatsoever. It's not physically feasible for an investor to make money off of an economy like that. That's why the dollar is said to still be the global reserve currency, and people will always have an infinite demand from borrowing from us. But on top of that, a fundamental turn to their entire case is that all the harms on debt are not associated with the amount of debt we have, but rather the ability to pay them back, which is the debt to GDP ratio. So if we increase the GDP aspect of the debt to GDP ratio faster than the debt, that's a clear way that the neg can link into this. We do this through things like infrastructure. Specifically, the Council on Foreign Relations explains that infrastructure is a fiscal multiplier. Every $1 invested in infrastructure is $3 back in GDP, so we can outpace our debt with our economic growth, exactly what the Clinton administration did. With that said, let's go to their first subpoint that talks about financial stimuli. You can turn the argument to our side because economic growth inherently gives you more tax revenue so that you can have more fiscal space in times of recession. The Council for a Responsible Budget explains in 2013 that every $1 of GDP is 25 cents in tax revenue, so we're creating more fiscal space. But secondly, we would say that recessions aren't necessarily solved by government bailouts. 2008 is the extreme example. The last recession was 2015, and that was solved by monetary policy, not fiscal policy. The Fed is already raising interest rates right now, so when the next recession hits, they can lower them and bounce us back out of a recession very easily. Their impact isn't that big a deal because we can already solve for it. But then they said that politicians will be less likely to extend the debt ceiling, but this just isn't true whatsoever. In 2008, politicians raised the debt ceiling 4 times. In the past 10 years, they've raised the debt ceiling 10 times. Any politician that wants to not help your economy in a recession is going to get kicked out of office. That's how let's go to their subpoint B where they talk about high interest rates. Turn the argument against them because interest rates are determined by economic activity, not the amount of debt we have. Specifically, Davidson of the New York Times continues to say that investors really care about having a stimulated economy and making more money back. No one wants to collect back on their interest in the future in the first place. But then they go on to talk about the Federal Reserve is the one who's going to raise interest rates to sell more United States bond. But again, this directly contradicts with what they say at the top when they said that they're not going to be doing that, they're just going to be printing more money that artificially deflates the value of the dollar. They have to pick one or the other. But on top of that, on their impact about emerging markets in the first place, in Crossfire, they say that it's FDI that would be going to emerging markets, but this is terrible for emerging markets because when U.S. corporations invest in their currency, they do so with malevolent purposes. Specifically, Nishat of the University of Karachi explains that 80% of all FDI comes in the form of mergers and acquisitions. This is terrible because they consolidate the industries and push out the poorest of the poor and just exploit developing countries. He finds that every 10% increase in FDI actually increases the poverty rate in developing countries by 4%. Voting for them just entrenches poverty in the developing world, which is never a good solution. You should help them out by raising their standard of living and having a tech boom in the United States that spills over to them. That's why we're proud to negate.
Okay, we'll do some prep. We have 145 left.
Gotcha. Yeah, what was that?
Okay, 143.
Okay, Okay, I'm gonna be starting off with our first impact on welfare. And then I'll be going down that case. Okay. And then I'll go over the term on FDI as well. Yep.
Okay.
Okay. Is everyone ready? Okay. Oh, actually, I'm starting off on his Wayne thing first.
Okay.
Right? Yeah, sorry.
Okay.
Okay. Time begins now. Go to the first thing. He said that in the Clinton administration, they had the dot-com thing. What happened after that? Literally, a recession passed. Literally, right after that. The reasoning behind this is because there's being too much money spurred into the economy at once. That's where the overheating is going to come in and being a really big turn on their whole entire case. Because right now we're at 4%. That means if you put any more money into the economy, it literally only leads to more overheating. But then B, he says there's a 3% decrease in the loss. I don't really know what this means. He just says it's gonna be a decrease because of the infrastructure. I'll get to this later. But then we're gonna be dropping our uniqueness scenario about how investors are leaving right now. What we are going to be winning is our impact on the interest rates. What we explained to you specifically right now is that we've increased our interest rates in the past year by 4 times. The reason behind this comes from Boskin. He explains to you that investors, in order to actually invest in the United States economy, because of the high debt, they require high interest rates. That's why the Fed is increasing it right now. The damning mistake he makes in rebuttal is he doesn't respond to our first impact on welfare programs. That's a clean extension. What we explain to you specifically is that right now, the CRFB explains this is a magnifying effect. When you don't actually act now and you act in 10 years, the cuts are going to go 2 times worse. That's horrible because when you have high interest rates, what Tully explains is that they're actually servicing 1/5 of the whole entire budget. That means at the end of the day, what Collins explains to you is he explains that it's going to be completely gone. The welfare, the benefits will be gone by 2029 and Social Security is gone by 2034. We impact out to Campbell, who explains 45 million people directly into poverty. The reason you're outweighing this argument over there's a couple reasons. The first one is on magnitude. I would say if you no longer have any sort of Social Security programs, then that means you literally are in the worst sort of poverty and you can't get out of it. Even if there is a productivity boom, it doesn't matter at the end of the day if so many people are going to be in poverty because they can't be contributing to the economy and they're only going to be hurting it even more. But then secondly, I would say on strength of link, literally this is the cleanest strength of link for you to vote for. We give you the link analysis. We explain to you that interest rates right now are going to cause this the highest probable scenario of anything happening in today's round. Go on to when they talk about the FDI is bad, but we would explain to you that the interest rates rising are the bad thing because that means that the consumers in the actual markets have a much harder time of actually paying for things because they take out interest rates and it's a lot more expensive for them to do this. That's the reason why they're pushed into poverty. Go on to their case. Couple of responses here. First, they talk about how there's going to be a productivity boom and how we need this right now. However, we take a couple of responses here. First, we mean overheating. What we explain to you is Horace 18 explains that specifically, America's high deficits are providing unneeded stimulus to the economy when it is already grown at maximum capacity. We would say Cox 18 explains that a recession is going to happen if you add any more money to the economy. That's only under their world. But then second of all, they can never actually be productive when there are high levels of debt, interest rates rise, and people on welfare that's only taking away from the economy at the end of the day. That's clear weighing there. But then, go into their first one. They talk about research and development. Couple responses here. First, their card linking to debt just says that sequestration in 2013 could have taken away from this. They say it's a new situation. They never knew any impact calculus or any impact clarity of how much research and development has to decrease in order for the debt to actually be prioritized. Because I would say right now, if Trump is investing, he's not going to pull out of here. He can actually do both at the same time. We don't need to prove this at the end of the day. But secondly, I would say that's why it's a much cleaner link for you to vote off the welfare cuts because you specifically tell you how much the welfare is going to go away. It's completely a way that's affecting a lot more people who are going to be pushed into poverty. Go into their second thing about infrastructure. A couple of turns. First, private investment is going to be decreased. Penetrate 17 explains that interest rates rise with higher debt. It reduces investment because it increases the cost of borrowing, making investment less profitable. DeRogi explains that the infrastructure investment is only coming from the private sector. When you have more higher interest rates, that means they only turn towards bonds. They don't actually invest in infrastructure anymore. They make it worse. But then secondly, interest payments are going to actually go away because what Guinness 18 explains is that because high interest rates, the highway trust fund is literally going to be gone by 2030. The reason behind this is the high interest rates they have to service.
We're going to take a look at that. Alright, are you ready for
Yeah.
Okay. So you can see that foreigners are still investing in the United States and not shifting away from everyone, and we can borrow for a while, right?
Yeah, we would say right now the only thing that we're
Really
doing.
quick follow-up.
Okay.
Why would they raise interest rates then?
We're saying they're being they're raising right now.
Well, the entire point of your case, like the internal link was that it's becoming more expensive to borrow, so they need to make it more attractive. But
Yeah.
if you concede to me that they don't care and they're still investing in the United States, then there's no link into raising interest rates as
No,
well.
no. Wait, what are you talking about?
So at the top, you say that foreign investors, like you concede my response, you can borrow indefinitely and people are still investing in the United States. There's lots of investor confidence because we have
Sure.
economic growth. So if that's the case, why would they raise interest rates then, which in your entire case is
Wait a second.
dependent on that problem at the top, basically?
They are raising interest rates right now in the status quo because the debt is rising.
Okay, so that's where we're going to have like a point of contention, right? We would say that they're raising interest rates because there's not enough productivity growth because of things like the trade war
Do you
and
have a card
because
for
of
that?
slowing economy. Well, I mean, yes, probably, but I don't have one. Like, I don't have the
Because
offering
we have
off
a
the top of my
specific
head
card.
right
We have a specific card that explains to you that the reason why they've hiked interest rates in the past year is because of the high
now. Are you
debt.
talking about
We saw-
the Federal Reserve interest rate or the bond yield interest rate? Because there are two different interest
No,
rates.
the Fed when they increase interest rates, it
Yeah.
affects every single market.
Okay, so you're
Like
talking
in
about the Federal. So you're talking about the Federal Reserve interest rate then?
Yeah, but that affects
Okay,
bonds
great.
as well.
Okay, yeah, I understand that, but I'm just saying. So
So can I
the
take a
terms
question?
we read still apply to that as well. But yeah,
So can I take a
yeah,
question?
you can take a question.
Okay, sure. Okay, so wait, I'm still kind of confused about. Okay, so if interest rates start to rise, right? When you say that it becomes harder to pay off the debt inevitably.
Okay, interest payments or the Federal Reserve interest rate? Because that means we can borrow
When the
more.
interest rates go up, so
Yes.
what we explained to you when debt increases
Well-
by 10%, there's a 2-point increase
Well,
in the amount of
okay,
interest rates.
Even if interest rates go up and becomes more expensive to borrow off, none of it matters because you conceded my response at the top. We can still borrow because people still like us a lot.
No, wait.
That's terminal
the
defense on
United
your entire
the
case.
United
They
States,
conceded.
wait, the United States government still has to pay for the interest
Yes,
rates.
but they can pay it and borrow at the same time. Because you
Wait.
conceded the response, we're the global reserve currency, there's an infinite demand for dollars. People will always want to buy
Wait,
U.S. Treasury
this isn't
bonds.
the status quo though. Our card from Collins explains to you that
The
the United
Federal Reserve is raising interest rates, right?
No. The Collins card, which you completely drop, explains to you that
On
status
the
quo.
budget, right?
What?
On the budget, like the federal welfare programs are not going to be sustained.
Yeah.
Okay, yeah, we do turn that as well.
I mean, you
We-
don't respond to it.
Yeah, we do respond to it. We say
Where?
we have more tax revenue as a result of economic growth, and we say that's dependent on interest rates going
Okay.
up. When we say in the long term they go down because of economic growth, like interest rates in the 1980s were like something in the double digits, and nowadays it's just a difference between 2 and 2.5%
No.
because we've had sustained
No.
economic growth.
The reason is you drop our card in case. What we explained to you is a 10% increase in the debt specifically is going to make a 2-point rise in interest
But
rates.
I'm debating about the
I'm
warrant.
time's up.
I'm debating about the warrant behind that.
We'll take a little bit of prep.
Yeah.
I'm gonna start on top of my case,
Okay.
and then like it's gonna address both the overheating warrants, like top of their case, top of my case,
Okay.
and then I'm going to infrastructure. Is everybody good? Alright. Starter overheating, they say we're at maximum capacity right now, which is why we can't add any more economic growth. They never respond to the Columbia University argument that tells you we are currently at very high U6 unemployment rates, which means we can still increase productivity and still have good growth. I would tell you, A, they have no warrant for why overheating happens, but B, that's because rapid stock exchanges happen what increases speculation, and that's what causes a bubble to pop in the first place, which creates the recession. I would tell you we're creating real jobs, not creating speculation, which is why they do not link in on our case. Go to infrastructure. They put two very bad responses here. For one, they say that private investment is going to go down. What I would tell you this isn't true because public investment is going to absorb risk for private investment, which is why to make Nicole evidence that tells you $1 trillion investment into public infrastructure is still going to be a functional link in our case. Then they say it's going to be less profitable in the future because interest rates are going to continue to go up. Again, I'm going to respond to this on their case, but I would tell you there's urgency to invest in infrastructure right now because if we don't invest in infrastructure, this is the weighing on their case as well. UC Berkeley tells you we're going to cost $3.1 trillion because the infrastructure continues to deteriorate and gets 600% more expensive. That's the first reason we outweigh. But secondly, we're going to directly link into solving for the debt because it's not about how much debt we have, it's about the debt to GDP ratio, which is why the Council of Foreign Relations tells you every $1 you invest in infrastructure gives you $3 that back because of the fiscal multiplier because it creates so many new jobs. But 3 on overheating and recession, we would link into solving for recessions as well. Hornbeck told you that the more you increase productivity, the more you increase wages by 1.5%, which means when a recession happens, you recession-proof us because people have more money in their pockets and they can increase consumption spending in times of recessions, pulling us out of a recession. But 4, we're going to outweigh on strength of link as well because they never respond to the Harvard International Review that tells you we are the global reserve currency, which means we have an infinite ability to buy and demand more debt from other countries. The US is the strongest currency in the world. All people want our debt, which is why we will never default. But instead, our linking is much better to the poorest part of the population because Bivens tells you we create 3 million new net jobs for the poorest part of the population, which means that they can get jobs and work their way out of inequality. But then, at the bottom of their case, we would argue that interest rates are going to go down as well because interest rates are determined by the strength of the economy, which is why the Davidson evidence tells you in the last quarter of 2018, because economic growth was so strong, interest rates were also at an all-time low, meaning we have uniqueness on this argument as well.
We're gonna take some prep time right now.
Wait, sorry,
Can I see the thing that's just the strength of the economy? Why interest rates go up? Oh, yeah. Okay.
Oh, we're gonna take off after we go. Okay, one other one.
Wait, where does it say interest rates?
Sorry. Minimum payment. That's talking about the interest payments.
Oh, okay, cool.
Okay, we have 38 seconds left. I'm gonna be starting. Sorry. I'm gonna be starting off on like the overview, down our case, down their case.
Okay.
I'll tell you where I am now. Okay. So is everyone ready? Cool. If everyone's ready, I'll start the time now. Remember the overview they read? Remember what Francesca tells you? That a recession is going to come because of 4% economic growth. They just responded like it's unemployment, the 4%. But our card is talking about the high economic growth right now is overheating the economy. If you continue economic growth, it's going to lead to a recession. That's only in their world. But then he just says that right now the United States is the global reserve currency. What we're telling you is that welfare is still going to run out. But then on this idea of like welfare running out, that's because of interest rates. Remember, Boston tells you that as the United States debt rises, debt holders demand higher interest rates to compensate for increased risk. And then Moore tells you a 10% increase in the debt causes a 2-point climb in U.S. interest rates. Remember that interest rates have increased by 4 times, and the Peterson G Foundation tells you that rates are literally increasing because of the debt. Their card is from 2016. We posted our cards are from 2018. What's really important is the increasing interest rates leads to welfare being cut. That's really important. The CRFB tells you that if we wait 10 years, we're going to see a magnifying effect, which means the cuts are going to increase by half. That's really, really bad because they're going to be insolvent by 2029, leaving 45 million people but then going on to the other case. Going on to this idea of overheating, we read it again, they just said their only responsibility is that it increases money for the economy, which solves back for overheating. That literally makes no sense. But then remember, like, this productivity they talk about, remember when people are in welfare, that means they're in poverty, which means this productivity boom they talk about can literally never be accessed. If people are in poverty, they can't contribute to the economy, they can't have this economic growth that they're talking about. But then on their idea about infrastructure, remember the two terms for discoveries which are really, really important that they don't really respond to. Remember that private investment is the biggest investment into infrastructure. That's really important. That's Penninger. He tells you though that the interest rates increase the cost of borrowing, which means that people are going to invest much less into infrastructure, which means in their world it only gets worse. But then second, remember that the highway trust fund is going to run out of money in literally 3 years because of the cost we pay to servicing the debt. That's really, really important because we would say that the best way to solve back for infrastructure is to have private investment and to solve back for the highway trust fund by decreasing interest rates. Vote for the affirmative.
Are you guys ready?
So let's talk about the overheating warrant, right?
Yeah.
So you guys say like if they're in welfare, they don't have productivity. Was that the response in summary?
No.
What was the response?
What?
What was the response in summary about productivity?
It was like welfare.
Summary.
There were two responses. Wait, first on
Yeah,
welfare.
like on the top of
Yeah,
our case.
on the top of our case, you said
Yeah,
that
you said-
welfare links into it, and we were just
Yeah,
trying to
I'm trying to
understand
figure
why
out why.
welfare.
Right,
links
sure. So we say the first reason why the overheating is going to happen is because when the economy has ever been this big, when you add more to it, that's when the overheating
Why?
happens.
Well, wait. Why does that mean overheating happens? You just say it's very big. Why does that mean overheating has to happen?
What do you mean? Why
Like,
is
what's
that?
the warrant for overheating?
What?
What's
Like,
the
what's the
warrant?
warrant?
What's the warrant for overheating?
Like, why does having a big economy
Yeah.
mean that it will overheat and cause a recession?
Like,
Because we would say right now the economy is at maximum capacity.
why?
Why?
Why is 4% maximum capacity?
Because like it's never been this high before.
it
definitely
been
has.
before.
Like in 2014, our
Or-
growth rate
Wait,
was
are you
at
confused
5%.
about? Wait, I don't understand
Like
what
the
you're talking about.
overheating at the
Wait, I don't
top.
understand what you're talking about the welfare thing.
No,
What
no.
are you talking about?
Was that
We're
not-
talking about the warrant for overheating.
Yeah,
so,
just the warrant
So
for
you're just saying we're at maximum capacity right now, and our case is literally why we're not at maximum capacity because we have high skilled people and low skilled jobs. There you have sticky wages.
Okay,
and
sure.
there's room for
So let's
productivity.
let's go into that warrant.
So
right?
is it speculation?
Wait, so sure, let's go into that warrant,
Sure,
right?
yeah,
So okay,
let's do
so
that.
if you're gonna be creating this productivity boom, right?
Mhm.
If tons of people are now put into poverty, right? Wouldn't they be
I
extracting
mean,
more
first
money
of all,
from
we
the
don't
economy?
we don't agree that people are going to be put in poverty. We're lifting people out of poverty.
How'd you lift people
Also, wait, which happens
We-
first? Like, the welfare cuts don't happen until like 2025 or 2048, right? So
I
it's
mean,
not
pretty
like you
soon.
invest in infrastructure
We're
and
saying
then
that
they're already poor.
no,
because
we're
there's no
saying
welfare.
that
Your
the
CRFB
cuts,
card
we're
comes
saying-
in 10 years, right?
Yeah.
Your CRFB
Well,
card.
we say we need to act now because if you don't act in the next 10 years, the cuts are gonna be
Okay,
twice
So,
as big.
but our point is you can't read it as a prerequisite because it
Yeah.
happens later.
What do you mean it happens later?
So the welfare argument that you're
No, we
saying
say
links
if we
into
don't
productivity
if we don't
happens
start
later.
prioritizing the debt right now in the
Yeah,
status
Yes, it
quo,
happens in
then
10
that
years.
Right.
well then that means that we don't have to cut it as much.
But it can't be a prerequisite if it happens 10 years after that our argument already happens.
When did we say it was a
Wait, this is no longer about overheating.
I-
Yeah, no.
I'm so
wait,
confused.
You guys,
Okay,
Wait,
yeah.
when was the when
Like
did we
the
say
two-
prerequisite?
the two responses at the top.
Oh,
of
so
our
it's
case
not
is
about a prerequisite?
One overheating and two.
Sorry, I
welfare.
thought I heard that.
Wait, I'm
as
so
well.
confused. Sorry.
We've been
Okay,
kinda
we've been
long
on this.
Can
You
we
guys,
talk-
yeah,
yeah,
you guys
you
can
guys
have a
go
question.
first.
Yeah.
Okay, cool, right? On like infrastructure, right?
Yeah. Mhm.
Okay, so the eternal impact of this is just creating jobs, right?
No, I read a bunch of weighing stuff in summary.
Okay, well what's like,
like
the
first we prevent adding more to the debt with the cost acceleration thing.
Yeah.
Second, we
Okay,
use the
sure.
fiscal
So let's get to
multiplier,
that.
so it increases
so
the GDP.
if you
and
were
third, 3
okay,
million.
so if you were to invest in infrastructure, right? Why would that money go towards going towards the debt if literally you're no longer prioritizing the debt
Oh, okay.
under your world?
Our argument is we don't have to pay off the debt at all. The argument
Why
is
wouldn't you
the
pay
more
off
you
the
the more you create GDP productivity, the more you have the ability to pay off mandatory interest rates, which means the interest rates no longer matter in the future because we always have money to pay it off.
Okay, cool. Do you have a question?
We're out of time.
Oh, okay.
Yeah, we're gonna take the rest of it. productive growth. They say that will create overheating and that will hurt the economy, creating a recession without really providing a warrant. The entire thesis of our case is why productivity stops overheating, because it's productive growth. It's not speculation stock exchanges that create asset bubbles and then create a recession. We're creating real infrastructure, real jobs, real employment. They never respond to the U6 unemployment rate being 8%. We have a lot of high-skilled workers and low-skilled jobs. This is why we're not at maximum capacity right now, because there are still so many benefits that we need to give to workers and investments here, which is why we won't be overheating. Secondly, don't let them link in with welfare whatsoever. That doesn't happen until 10 years down the line. Our benefits materialize first. They don't have a prerequisite. Let's go to infrastructure. They say that private investment is always better, but remember what Andrew said in the summary, they don't respond to. Public investment absorbs risk for the private sector, which is why the $1 trillion spending bill that Congress has also includes provision for public infrastructure and tax cuts for private investors to invest in low-income infrastructure areas in the first place. Then they say that the highway trust fund is going to run out of money. Our entire point is we shouldn't take the money from the government budget. It's financed by going into more debt. That's the neg advocacy in the first place. Here's why infrastructure outweighs every other argument. First, on urgency. Remember, it's deteriorating right now. We can't wait for the future for the highway trust fund to be stabilized to us to invest in it. Secondly, on time frame, because the UC Berkeley evidence they never respond to, don't let them do it in Final Focus, is that the more infrastructure deteriorates, the more it adds to the debt. It can add $3.1 trillion to the debt. So if you don't invest in infrastructure right now, that's going to lead you with a more debt burden to pay off in the future when you vote AF. But then thirdly, because everything on their case is dependent on a debt to GDP ratio, that response goes cold dropped as well. Remember that infrastructure is a fiscal multiplier. Every $1 in infrastructure is $3 in GDP. So we're lowering the debt to GDP ratio so that we make sure that debt is sustainable, so that we make sure that we don't cut things like welfare in the first place. But finally, we would say our impact supersedes welfare, because when you give people wages and productivity and jobs, they don't need welfare in the first place because they have a living wage. But then finally, because the overheating and recession argument, they can spend their way out of recession. But also, they conceded terminal defense on their case. We can borrow forever with the Harvard International Review or the global reserve currency. Interest payments will never be a problem because we can always finance them that way. That's why we're cut to negate.
And then what's your remaining question? Okay, I'm going to be starting off on welfare and then going to infrastructure.
Okay.
Is everyone ready? Cool. Time begins now. Go to our subpoint B about interest. The critical mistake he makes in Final Focus is dropping the Peterson G Foundation card. What it explains to you that interest rates rise when you have more debt. The reason why this is so bad is our Moore card. What it explains to you, there's a 10% increase in the amount of debt, it leads to a 2-point increase in the amount of interest rates. The reason why that is so bad is because at the end of the day, they dropped the CRFB card. What we explain to you is if we don't make the cuts now into our debt and prioritize it, it means that the cuts are going to be 2 times worse, putting people into a magnifying effect of poverty. But even if you don't buy that analysis, you still buy Collins, who explains in the status quo, with investors still in the United States, the trust funds and all this is going to run out on welfare by 2029 and Social Security by 2034. The reason why you're going to be outweighing this argument over all their arguments is for 2 reasons. The first one is that if you're in a state of poverty, that means you can never contribute to the economy. That means you're taking away from it. Even if they do prove a productivity boom through the infrastructure being created, it doesn't matter because the people who are poor are going to be hurting it the most and actually taking away from it. But then secondly, I would say that the people who are poor can't even access the infrastructure jobs because they won't be able to get any sort of employment or any sort of resume to be able to do this, because at the end of the day, they don't have enough money to be able to do this and to go into infrastructure or any of the jobs that they talk about. The reason why you're going to be prioritizing the people that are the poorest the most is because literally they have nothing. These are the people that are going to be affected the most. That's why Campbell explains to you that 45 million people are going to go directly into poverty. We are the only team that has impact clarity. But then on the 2 terms we read, first on the one where we talk about the private investment, he just said the public investment is going to be taken up this way much. However, we would say that the private investment right now is the major theme leading into the infrastructure right now. When you take it away and they focus on bonds, that means you take away a critical area from infrastructure. But then secondly, I would say on the highway trust fund, you should prioritize debt reduction right now to actually have a bigger highway trust fund